Today we're going to work on the return on assets ratio. The return on assets ratio has net income, which is the return or the profit, over average total assets as the denominator. And the name gives away a little bit what the ratio, it's return on top of assets, return on assets. So that's a little hint that assets is in the denominator. Some folks use different numerators. Some folks use operating income, especially if they're evaluating managers, rather than net income, because operating income is the profit before non-operating items. So if you're a manager, maybe you're not going to be evaluated on non-operating things, just operating things. But for us here in the principles of accounting, we're just going to use net income over average total assets. As you get into more advanced courses or into some of your finance courses, you may be using EBITDA, earnings before interest and taxes, or some other version of return in the numerator. But this is what we're going to use. The denominator, average total assets, is taking the total assets at the current year and the total assets at the end of the prior year, adding them together and dividing by 2. So let's try it. Here is a little picture, a little subset of General Mills's 2011 income statement. And at the bottom is their net income. They call it net earnings. Some call it net profit, but income, earnings, and profit are all revenues less expenses. So this 1,798.3 is our numerator. And here is a piece of their balance sheet showing the total assets for the current year and the prior year. So we add those together and divide by 2 and get the average total assets, which is the 18,176.7. Now we're ready to compute. We take our numerator, net income, over our average total assets, and we get 0.0989343, which if you move the decimal to the right too, you can convert it to a percent, which is typically how it's reported. And we get 9.89%. Rounding to 2 decimals is like money, is pretty much the convention. How would we use this? Return on assets helps us to put profits into perspective. Not just did you earn money, but how much did you earn given the assets that you had locked up. It tells us if you're earning enough to cover the cost of those assets, because assets aren't free. You had to borrow them or get them from owners who expected a return. So return on assets gives us something to compare to the cost of assets to see if we're earning more. It gives us a chance to reveal if profits are improving, so we can compare return on assets to a prior year. We can also compare our return on assets to competitors or industry average. So let's do that for this computation. Here is the footnote for debt for General Mills in 2011, and we see, it's circled in red, their interest rates float around between 5 and 6, except for the very short-term note there that's at 1.55. So our return on assets of 9.89 is quite a bit above the cost of capital if we use debt as a benchmark. So that's good. That's helpful. So that's something to compare it against, a benchmark. We can also go, I went to Yahoo and I looked up their competitors and I found Kellogg's, and Kellogg's return on assets is 12.84%. Well, that's not as good. General Mills is not as good as Kellogg's, so we can compare to competitors and see whether that's a good return. And here they're falling short of Kellogg. So now you're ready to look at some other ratios and go back and work some homework.